Hi, everyone. Thanks for joining. We are giving a few minutes for people to join us. Yeah, maybe I can start with introduction as people are joining us. Welcome, everyone, and thank you for joining us today. It's 11:01 actually here in Calgary. So we'll go ahead and get started. My name is Sam Ashuri. I'm the program manager of the NGIF Emission Testing Center program at the NGIF Accelerator. I'll be the moderator for today's session. This is our fifth installment in the TechTalk series webinar, and this is our first one in 2025. So we're so excited for that. And today's session focuses on Alberta's Technology, Innovation, and Emission Reduction, or TIER program, the key piece of the province regulatory and incentive framework for emission reduction. We are thrilled to welcome two experts from BMO Radical who will guide us through how the TIER program works, what recent update means for methane technology, and how technology developer and industry stakeholders can generate value through crediting and market participation. Before we dive into the main presentation, I'm going to take first 5 minutes to share some update on the NGIF Emission Testing Center and our new commercialization support program. But let me first share a few housekeeping notes. The microphones are disabled during the presentation. We will enable audio and camera for the Q&A. Feel free to use the chat box during the presentation. I will try to address the question as many as possible during and after the presentation. This session is being recorded, and the recording will be shared on our website at etc.ngif.ca. And at the end of the session, we'll share a survey link. Please take a moment to fill it out. Your feedback helps us to improve. I'd like to take a moment to highlight that the TechTalk series is an initiative of the NGIF Emission Testing Center, or ETC program. Through the ETC, we provide a platform for methane technology provider to test and field validate their solution in real-world conditions. But our work doesn't stop there. The program is also designed to accelerate the path to commercialization by sharing insight, building industry connection, and supporting the adoption of innovative technology. This webinar series is one way we help bring critical knowledge to the ecosystem and support the scale-up of impactful methane solutions. Some of you may recognize this slide from the PTAC Methane Leadership Summit just 2 weeks ago, where we officially announced the launch of our commercialization support program. While NGIF continues to offer robust technology testing and field validation through our consortium partner, we are also building new pathways to support market readiness and adoption. Our commercialization support program is designed to bridge the gap between technology development and industry uptake. Today, I'm not going to spend time talking about the 4 pillars, but I highly encourage you to go to our website to learn more about these pillars. I just need to take a few minutes to highlight the pillar 3 of the program, which is a technology adoption platform. This technology adoption platform is designed to connect validated methane technology with potential adopter and investor, accelerating real-world implementation and market entry. We are currently accepting applications through May 27th. We are seeking technology at TRL 7 and above, those that have already undergone field validation, whether through pilot project, or maybe some kind of early adopter customers or testing program like the NGIF ETC or METAC. Each applicant must be accompanied by an industry partner who can serve as a champion for their technology. This partner will provide context to how the technology has been applied in the field that helps others understand its potential value and practical benefits. The application process is straightforward. It's a simple online form, and we review submission on a rolling basis as they come in. If you're an operator or investors interested in participating in the program or connecting with emerging technologies, we'd love to hear from you as well. You can reach out to us via the contact page on our website. I highly encourage to go to visit our website to learn more and apply. All right, now let's dive into the main conversation. You've joined us today. I'm pleased to introduce our two distinguished speakers from BMO Radical, who bring deep expertise in environmental market and carbon credit strategies. Our first speaker is Cooper Robinson, Director and Innovation Lead with the Global Market Team at BMO Radical. Cooper is focused on making sustainability profitable at scale, and he's been deeply involved in several first-of-their-kind carbon projects, especially in the energy and food or waste sectors. He co-founded CapHop Energy, a company dedicated to scaling carbon solutions, which later became part of the Radical and eventually BMO. Over the years, Cooper has helped a wide range of clients develop new ways to monetize carbon through projects like CCUS methane abatement in oil and gas and low carbon fuels. He also shared his expertise as a guest lecturer at the Haskin and Ivy Business School. Joining Cooper today is Court Ellis, also from BMO Capital Market. Court works on the sales and trading side of BMO's capital market strategy with a focus on environmental commodities. He helps clients navigate the complexities of carbon market and bring a strong result-driven approach to everything he does. Court is known for his strategic insight and collaborative style, and he plays a key role in delivering innovative market solutions to a wide range of clients. Court holds a Bachelor of Business Administration from the University of Lethbridge. All right, thank you everyone for your patience and for joining us today. I will now pass the mic over to our guest speaker. Cooper and Court, the floor is yours. Please go ahead.
Fantastic. Thanks so much, Sam. Let me just get a slide up here. Hopefully that is showing. Are we good to go?
Yeah.
Okay, awesome.
Yeah.
Good morning, everybody. As Sam said, Cooper Robinson. Just going to quickly start by thanking the organizers here. Thank you, Sam, for the introduction. Thanks, NGIF, for hosting, and to everyone in attendance, and to my co-panelist, Court. Just a privilege to chat with you all today, share some of our thoughts on carbon markets, hopefully decode or sort of demystify some of the things you may have heard or some of the things you maybe haven't heard. So we'll quickly sort of introduce ourselves here, give a bit of a global backdrop or global context. Then we'll drill down to Canada, we'll drill down to Alberta, drill down even further into methane and sort of pathways to monetization, and then open up the floor to some questions. So quickly, just to get to that content here, some of you may be familiar with Radical. We're homegrown here in Alberta, Canada, initially as Carbon Credit Solutions, CCSI, CapHop Energy, later as Radical. But just over 2 years ago, we added 3 letters to our name when we were acquired by BMO. So it's a bit of an introduction for some of you, maybe a reintroduction, but it's also, we think, sort of a somewhat relevant data point in the global transition that we're talking about here. Is one piece maybe of a much bigger picture where carbon markets sort of enable think of it as like the convergence, right, of climate and finance, of treating greenhouse gas emissions more and more like a currency or like an asset or a commodity to be managed and traded and valued. So I'll talk a little bit more about its characteristics as sort of an asset class in a minute. But first, a question that I was asked a lot, which is, why does a bank acquire a carbon markets firm? I think in short, it's a little bit of the same reason that a lot of you are here today. Carbon markets sort of recognized as as this important tool, but they're also immature and nascent and opaque and complicated. But really there is value in unlocking that complexity as these markets begin to mature. I believe that market maturity is coming. There's a bunch of sort of pieces of evidence on this slide bolstering that global transition to a lower carbon economy. But reality is still today that, like I said, carbon markets are extremely difficult to navigate. There is, I think, reason for optimism. There's folks you can draw on their expertise, like Court and I today. But one of the things we still see a lot of companies struggling with is treating carbon off the side of someone's desk, or worse, just kind of assuming that you're entitled to carbon credit revenues that will somehow magically materialize. So we'll talk about that today in terms of how that process works. So I'll start just by framing the global markets. One of the things I find useful, like I said, is to think of carbon as an asset. Businesses with this mindset are now seeing that the transition can be approached as an opportunity. Saw a stat recently of McKinsey figure of $275 trillion in spending on physical hardware to reach net zero. $275 trillion doesn't move without the financial sector, and things don't get built without, all the folks on the line and many others. So if there's nothing else that you take from our chat today, let it be that, if you see some of the evidence over the long term, you see the pace of change that, speeds up and slows down, but is moving ever in one direction. We feel the advantage will tilt to those who can reframe carbon from a cost, from a liability into an asset. And really every business can do that. I think all of the businesses here today are doing that in some way, and even a coal power plant can sort of do that reframing. It's not sort of as foreign as you may think in terms of market dynamics, and Court's going to give us a deep dive with a lot more depth on this in terms of some of the different trends within Alberta. But this is another common question we get, is about pricing. You can imagine today there's 30 different compliance markets, over 100 different ways to create a carbon credit of one type or another. So there's very different pricing levels around the world. But in this analogy of carbon as an asset, comparing it to energy here, that the drivers of these markets, at least at a high level, are not so different. The fundamentals are not sort of mystical or esoteric. They're just new. And, focus on the last one here as an example. Might be a different page of the newspaper that I need to tune into, or it might be a different sort of relative weighting of the importance of each of these drivers, but it's often at least sort of reasonably predictable over a reasonable time horizon compared to energy, I think. But my definition of reasonable may be a bit different than yours. Really, from where I said volatility is a characteristic of a lot of markets. I mean, maybe it's just a characteristic of modern life. So let's flesh out this global picture. I think a crucial thing to remember is that net zero is not zero. The net means balanced emissions, not zero emissions. So balancing is trading, is market. So really quickly here, global context, Paris Agreement, kind of the overarching piece here. I wasn't able to find an updated version with the US having actually exited the Paris Agreement again. But the green and blue countries here are open to trading reductions and removals with each other. But that's not really something that happens today, believe it or not. This Article 6 is being operationalized, but trading across borders for what we call compliance markets is hard. We can't even trade between Alberta and Saskatchewan or BC yet. So there's some really interesting research done a few years ago that showed this ability to trade, especially between countries, which again is governed by Article 6 here kind of broadly. But trading can enable greater ambition at lower cost. And of course, again, trading is markets. What we do have today is compliance carbon markets and voluntary carbon markets. So I'll quickly go over those. From this perspective, Canada is sort of middle of the road, but moving up on pricing. We've been quite robust when it comes to coverage. That's changed a lot in recent years. As you probably know, we've been pricing more emissions in the country up until recently, getting rid of the carbon tax. In terms of of that price, both in Alberta and in Canada. There's currently legislative requirement for that price to go up pretty significantly, actually, in quite a short time frame. And there's a lot to go deeper into all of this, but the point is more just to understand this global context to all of this, the compliance side of the markets. That's over $1 trillion per year in total value, most of that coming from, like I said, the relatively mature European scheme. Visually, the compliance markets that exist today, just showing here that there are dozens of compliance markets, of course, Canada included. Comparatively, voluntary markets have been growing. This is a bit of a historical look, but in the maxed out here in the last few years at the low single-digit billions per year, total value dipped below $1 billion for 2023. I don't think we have numbers for 24 yet, but this is interesting to me because as far as headlines that you read and where it seems like a lot of the action is happening, it's here. Hundreds of companies trying to develop different types of carbon credits and develop different carbon programs in the USA and around the world. Meanwhile, like I say, in Canada and Alberta, we've been doing it for almost 20 years, and in terms of value, voluntary markets just haven't quite sort of caught up yet. If we expect they will, I'm not sure. But one of the most basic things to consider then is, do I want to participate in the compliance market or the voluntary sort of at this point, and what opportunities maybe do I have in both? So again, we're talking Alberta tier today, and I'll pass it over to my co-panelist Court here. But yeah, hopefully that's helpful to give a bit of a global look at things. Court?
Thanks, Cooper. First of all, yeah, thank you, Sam and Jaya, for having us, and for everyone here in attendance, and Cooper, to you as well. It's always a pleasure to share these type of events with you. So if you want to maybe just jump to the next slide, please. So we'll kind of focus on here the actual North American scheme. As Cooper mentioned, obviously there are multiple different carbon markets out there, but today we'll focus on Canada and then Alberta specifically. So within North America and Canada, there's the Canada Greenhouse Gas Pollution Act. Essentially what that involves is that in Canada, for a carbon market, every province is federally regulated to have some type of carbon pricing system composed of kind of two parts. One is the federal fuel charge, which as of March 15th this year actually was reduced to zero. So in the act itself, it is still in place in the policy, but the charge of it remains at zero for this part. The second component is the performance-based system for industries, all that we call the output-based pricing system, or OBPS. What that entails is that every province and territory has the option to either design or implement their own provincial system, as long as it meets what the federal government requires equivalent. If they don't have something in place, then one or both parts will just fall to like the actual federal backstop. So as you can see on the right in the graph there, it'll just kind of give you an outline of what the different systems in Canada are. Obviously, Alberta, Saskatchewan, Ontario, they all fall under their own provincial system that's been deemed equivalent by the federal policy. And then BC has their own provincial program, their BC OBPS. And then Quebec is kind of a separate one where it actually mirrors and correlates directly with the California West Coast or West Carbon Initiative policy. As we move down into the US, there's a bunch of complexities in the different markets there. 11 states have active carbon pricing systems. Part of RGGI, or the Regional Initiative Program in the American Northeast. And then also, as we mentioned, California and Quebec are linked by the West Coast Initiative. So, Cooper, we can move to the next one, please. So just kind of going into the actual framework for Canada a little bit more, like we had mentioned, it requires all provinces to have an implemented carbon pricing that's met the federal equivalent based back in 2018. If no provincial system is in place, we would just use the federal backstop as the kind of default there. Then as you can see here, the main component of the federal pricing system is to be deemed equivalent by the federal government. Provinces must adhere to the federal price escalation on carbon. So starting at $80 a ton in 2024 with an annual rate of $15 to reach $170 by 2030. We'll dive into this a little bit more kind of later on in the presentation, but obviously with what's going on with government right now and our new/old leader in, we could see a change at the actual price escalation in our mind. One other thing I would add here, as we mentioned, the fuel charge is still technically in place under the Act. The price of that actual fuel charge is just down to zero at this point. Cooper, if you want to move to the next one. So focusing on Alberta's tier, the carbon pricing system. So Alberta's is an output-based performance compliance system, which includes revenue recycling to help fund emission reduction projects through Alberta granting programs. This incentivizes industrial carbon pricing and emissions trading systems, as well as it finding initiative ways to reduce emissions and invest in clean tech. So this applies to all facilities that emit over 100 tons of CO2 equivalent a year, but also it gives the option for smaller facilities to actually opt in to the program as well. Currently under tier, there's 18 quantification protocols that exist for GHG reduction project types to generate tier offsets. And then Cooper and I will get into these as we move on. If you look at the top figure in the right, for tier, you can see the picture on the left. It actually shows what the facility benchmark would be for someone that is registered in tier. Facility B on the left, you can see where the benchmark is, the dotted line there. Anyone above that would be purchasing into the tier fund. So there's a number of ways to do that we'll get into. The one on the right in blue is actually under the benchmark. So they're operating at a better standard. This would make that facility eligible for generation of EPCs. The bottom right there just shows some of the ways that you can actually generate the tier offsets through some of the protocols that we'll get into in a moment. Cooper, you can go ahead and move on. So for obligated parties into tier, there's basically two ways that you can meet your tier obligation. If a facility has a tier obligation, as you can see up on the left there, the first option is to pay into the tier fund by purchasing fund credits at whatever the federal price on carbon is in that compliance year. The second option that you can see on the right is submit EPCs or offsets that were either internally generated by emission reduction projects by that obligated party, or to purchase these within the secondary market. Currently, the obligation limit for submitting EPCs and offsets is at 70%, which will increase up to 90% in 2026 and then moving forward. On the right there, you can just kind of see a graph on the actual level of EPCs and offsets that have been generated from 2020 onwards. Those red lines there actually show what the limits could have been and then compared to what was actually submitted. Cooper, we're going to the next one, please. Here we actually just talk a little bit about actual historical offset generation. Obviously, offset generation has increased over the years, especially as the price of carbon has been increased. Below on the left, we'll show some examples of some of the protocols and the volumes of credits that have been generated through those. So most offsets have been generated historically through the 4 different protocols, the main being pneumatic devices, carbon capture and storage, enhanced oil recovery, and wind-powered electricity generation. Then on the right there, it shows just what the active quantification protocols are, with some of the ones that have been withdrawn over the past number of years. Cooper, if you want to go to the next one, please. So now we can talk in a little bit about the actual pricing components of these in the secondary market. Historically, the secondary market pricing has traded around a 10 to 20% discount of whatever the actual federal price on carbon has been. Currently, right now, we're not seeing those. It's more at about a 50 to 60%. A couple of factors that have played into that, one being the volume of credits and offsets generated, have outplaced what the actual submissions have been for retirement. The top graph on the right there will kind of show that a little more detail, where the lines in red there actually show what the usage limits could have been, and then in relation to what was actually submitted by EPCs and offsets are the fund credits being actually purchased. Generally, what we think happened with this was there was an oversupply of credits within the market, and producers are, parties that were generating these offsets were just holding them and paying the tier fund price and hedging these, with especially these ones that had 8-year expiries on them. The bottom left graph there actually shows what the tier fund price will be escalating, and then the secondary market price. So as you can see, at times, there was actually a point where the secondary market price was trading higher than the tier fund, which where we also think played into the amount of EPCs and offsets being retired, is that it was just easier and more cost effective to pay the actual tier fund price on carbon and hold on to the offsets as they appreciated in value over year after year. Cooper, you can move to the next one, please.
Just before we move on, I want to add one thing, which is when we talk about the inventory in the market, we do tend to use this word oversupplied, but at the top right is a bit of an example of why I might be alone in this, but I prefer the term under demanded to oversupplied, because, and really it's, 2022 is a good example of that, where the credits could have been used. There was sufficient usage limit available. And so the reason that we have more inventory today is not just because of the supply of credits, but it's also because of the demand of credits and folks not using credits when they could have, for the reasons that Court just mentioned.
Yeah, that's a great point. Thank you. So as you can see on this chart here, it's just a little more in-depth look at what the actual trends have been on pricing. As you can see, the solid gray bar there is the current tier fund tax rate increase, with the blue on the secondary market price. We do expect prices to start to rally and level out for a number of reasons. One, as more and more credits and EPCs get retired within the market, as well as that an obligated parties limit of credits and EPCs that they can retire will go up, as we showed before, for up to 90% starting in 2026. And also, we saw a bit of a dip with this with some of the political uncertainty leading up to Monday's federal election, with the Liberal in power again and some of their commitments to green initiatives and carbon reductions. We do see this price and the need of the system to continue. Currently, the mid-market price for tier credits right now is in that $30 range. And obviously, like we said, look to maybe increase it time over time. Could we go to the next one, please? This is just a breakdown of what's kind of in the market right now as far as tier credits. The point I'll make first is in the top of the graph there on the left, you can see that the vintage years and the years of bankability, it changes from 2023 onward. So prior to 2023, credits that were generated under tier had an 8-year eligibility on them to help kind of tighten that supply and demand. Anything from 2023 moving onward now only has a 5-year expiry. So just something to be aware of for anyone who actually is generating or retiring credits, what those timelines look like. You can see in the top right the current inventory by vintage year. And then down in the bottom right there, kind of what we forecast as far as inventory moving forward, as far as offsets generated, EPCs generated, and then submitted on both. Cooper, we can go to the next one.
One of the things that's interesting about expiry too is, so we model this and we show that in a rational market, expiries are not really relevant. But keyword there is a rational market. Like I mentioned earlier, these markets are opaque and they're difficult to navigate. So sometimes we will see what I would call irrational behavior, at least from a market perspective. In other words, credit expiry is not relevant, assuming that you do things like vintage swaps and things like that, which would enable you to sort of use the full life of a credit before it expires. But what we see actually happening in the market is, if people have credits in their account, then they may use them for compliance, or in some cases, even like I said, where the price is today, companies should be retiring as many of those credits as possible. We still see folks paying the tier fund price and not using credits. So just making sure that the information is available is sometimes a big part of the challenge.
Yeah, that's a great point. So last that we'll just add here is an update on tier post-election. With obviously the Liberal government winning and Mark Carney, the reinforcement of the industrial carbon pricing. The Liberals have petitioned and campaigned that they are looking to make big emitters pay while protecting the competitiveness of the Canadian industry and improve the output-based performance system for large emitters. Addressing the credit oversupply. Current inventory stands at just over 50 million tons combined EPCs and offsets, with retirement obligations closer to the 14 million tons for 2024. Likely that the federal government would look to enforce that equivalency and provide support. And then also just the pricing schedule. We predict that they'll look to enforce or provide clarity on planned adjustments to the pricing schedule. And if it does go up to that 170 by 2023 benchmark. I will also add to this, here is under review, a scheduled review for summer of 2026, where we do think that more kind of focus will be on the equivalency to the federal backstop program at that time. And Cooper, I'll pass it off to you, or I guess both of us are for the credit development component.
Yeah, a couple of other things that we see, with this election outcome. So even before the election outcome, with the carbon tax going away, implications potentially on strategy for tier aggregates, which is where majority of sort of the smaller oil and gas facilities are currently regulated. So largely the tier aggregate program was designed as an alternative to the carbon tax, and now with the carbon tax at zero and likely going away altogether, just the strategy of how you sort of manage that tier aggregate program, we think there's some implications there. Also implications that we'll talk a little bit more in a second about offset generation. And so you can only generate offsets on emissions that are not otherwise priced or regulated. And so again, with the sort of emissions that would have fallen under the carbon tax previously, those would not be eligible to generate offsets from. And now with the carbon tax going away, that opens up a new avenue for offset generation. And some of the protocols that we've seen in the past, such as engine fuel management, that went away as a result of carbon tax overlap, we could see potentially credit generation eligibility coming back on those. So a bit of a TBD on some of that, but that's directionally how we see some of that going. So we'll chat quickly through here on the credit development. So how does this look under tier today? And with the audience that we have today, especially focusing on methane reduction. So a couple of pathways available, or 3 pathways really that we see available. Court's going to give us a deeper dive on those, but just want to frame up a little bit of the context here. So the way that it works with methane, sort of chapter 1 of this story, was that the prior governments, both federally and provincially, had established these 45% methane reduction targets for 2025. And a bit more detail on the slide here, but the short version is that we as a province achieved that target a number of years ahead of schedule, in large part, according to the AER's website, directly in large part due to early action incentives like offsets. So this has been, like I said, chapter 1 of the story, where the setup is a bit of, we think of it as like a carrot and stick, where if you comply with these regulations early, take advantage of these pathways to generate offsets, and then that enables you to sort of reduce your compliance cost, when the stick of regulation comes in later, or in some cases eliminate that compliance cost altogether. In some other cases, even generate a profit or incremental revenues on top of being fully compliant with certain aspects of the regulation. There's aspects that are not suitable and not covered by the offset opportunity. But in chapter 1, that was really focused on the high to low bleed conversion under the pneumatics protocol. What we want to highlight here is that there is a chapter 2 of this story shaping up that looks very similar. A methane reduction target. Again, this is an election update to the slide that we made in the last 48 hours or 24 hours. That, within that Liberal platform, there was language around finalizing enhanced methane regulations. That's their words, in support of that 75% target. What has also happened, setting up for chapter 2 here, is that Alberta has revised the existing pneumatics protocol. So we still have pathways there under instrument air and device electrification that we'll talk about. They've also added a protocol a few years ago for vent gas reduction. So really covering a larger set of sources across the board here that are also covered. We believe, like, we don't have the final regulation, but a lot of these sources look like they would be regulated under that future regulation. The reason that's important, and again, the stick end of the carrot and stick analogy, is that when the regulation comes into effect, so again, if we think about chapter 1, when low bleed pneumatic devices were required, offset generation from high to low bleed retrofits ended. Same thing will be likely true here, is that when the regulations come in and require an action, you no longer get offsets for it. So we have this sort of time limited window of opportunity where, like I said, early action really gets the carrot, generates the offsets, and the later you wait, the fewer offsets, and ultimately the less compliance cost can be recouped. So just want to set the stage there. Court, I'll pass it to you if any other comments on this, or you can walk us through the pathways themselves.
Yeah, that sounds good, Cooper. I think you could move into the device electrification and get into. So as Cooper mentioned, the 3 main pathways that we usually tend to see within Alberta for credit generation are through the pneumatic device electrification. So what basically that entails is products to achieve GHG emission reduction by converting eligible pneumatic-driven devices on sites, generally to electrically powered. Basically, they can be driven by grid-supplied electricity, on-site power generation, including renewables, or on-site fuel combustion. Down towards the bottom there, we can see a little bit of the eligibility for these actual pneumatic changeovers. And then at the very bottom, it's a little bit of the credit development flow that we see. So generally how that works would be the site identification, assessing the eligibility of these projects, the actual assessment of the opportunity, the data gathering, listing of the project within the registry, and then ongoing monitoring and maintenance of the actual projects themselves to the time that you are actually able to generate or serialize those credits. Could we move to the next one, please? The second that we generally see the most of is vent gas reduction. So these are projects that were previously venting gas into atmosphere. Then they're either captured and either conserved or destroyed under the vent gas reduction protocol. So there's two categories within this protocol. Category one is conservation. So that would be capturing of vent gas with injection into a sales or gas pipeline, or use it for stationary fuel combustion on site. So that could be in the form of heat generation or on site use for power generation. The second is destruction, or category two, which is incineration or enclosed combustion, are tied into an existing flare stack. Currently, right now, as the protocol stands, this category two is actually set to sunset at the end of September of 2025. There are discussions in place for extension of this protocol, but as of right now, that is the end date on this. The baseline for this condition is obviously natural gas venting to atmosphere. Oh, sorry. Yeah, go ahead, Cooper. You can move to the next one. The last one we see is instrument gas to instrument air. So instrument air systems can reduce the venting within an oil or gas site. On the bottom left here, you can see the eligible devices. So pneumatic controllers, switches, transducers, or positioners, and then pneumatic pumps, methanol or pneumatic. This does not include energy exchange pumps. And then the eligibility at the top there. Cooper, we move to the next one.
Great, thanks, Court. So yeah, those are the tier. Again, today we're focused on tier, but just to quickly show that there are a range of other pathways. So the clean fuel regulation is a carbon market that we didn't talk about today, but it is in place in Canada, and it does also have pathways to monetizing emission reductions from upstream oil and gas sector. And so just to make folks aware of that, and then we'll finish up here so that we can get to some questions. But a lot of detail on the slides the court went through. Want to just give you like a really maybe more memorable, simple way to think about how do we generate a carbon credit. This is across any carbon market. You really need sort of the 3 Ps. You need a project. The reason that is not as obvious as maybe it sounds is that we have a lot of folks come to us and say, hey, I've got this great technology. Can I get carbon credits? And of course, you need to actually implement the technology. We need to be able to draw the boundaries around what the project itself is. And again, that matters whether the emissions are regulated, whether the emissions are priced, and all of those sorts of things. You need a protocol. We talked about the pneumatics protocol today and the VGR protocol today, but basically you need the protocol and the project type to match up to enable carbon credit generation. If they don't quite perfectly match, then there's sort of a range of different options as to how you do that, including up to it and including developing new protocols for new project types. And then you need partners. I mean, I think, again, this sort of goes without saying, but even if you had the expertise internally to do the process yourself, you're going to need a third party to verify. So there is verification or audit requirements in the majority of these programs, especially compliance programs. You're going to need somebody to value the credit itself. So whether that's an offtake, whether that's a government partner who's putting a compliance value on it, and so on. And so just remember sort of the 3 Ps of how to generate a carbon credit. We won't go through the detailed life cycle here, just in the interest of time, but we'll kind of include these in the materials that get sent out. And so that's all. Thanks very much the presentation or for listening, and we'll go to Q&A now if that's good.
Thank you so much for sharing your insight. It's really valuable. It was great. We have a question in the chat. I encourage people to start typing in the chat or raise hand to ask question. The question says, how does fuel blending, such as hydrogen, apply to the wind gas, assuming low carbon hydrogen is reduced CI of the wind stream?
I'm not sure that I totally follow the question, but venting hydrogen, I don't believe is regulated.
Okay.
If that's what the question is asking.
I think it says reducing the carbon by blending hydrogen. Does that generate any credit?
So hydrogen, I would say more generally, hydrogen, I actually often use hydrogen as sort of the case study when I'm doing any kind of guest lecturing or things on the case study and just how complex carbon policy can be, because really it, depends on the type of hydrogen, but assuming blue hydrogen here, you've got almost every single layer of carbon policy that you could have from, the production of natural gas that might be in a tier aggregate, get that to the SMR or other sort of hydrogen producing facility, that might be a large final emitter. And then if you're capturing CO2, sending that and sequestering that, then that's an offset project. The use of the hydrogen, the end use is regulated in different ways, could be eligible under CFR, for example. So there's almost literally every single carbon policy that exists in Canada that applies to hydrogen throughout the life cycle. So it's quite a complicated one.
Okay. Yeah. So the question is, how does the result of the federal election affect the future of the tier program?
Yeah, so I think, we went through a few of those examples, but I would say a lot of what we've read in sort of the platform analysis looks to keeping industrial carbon policy similar to how it is today. And really words like tighten or strengthen were kind of some of the verbs that we read. So, as Court mentioned, we see this impacting the tier program, tactically in an equivalency discussion. And just to explain a little bit more what that means. So the federal backstop is not just a backstop in terms of structure, but there's a list of criteria that that sort of the federal government and the provincial government would evaluate in terms of determining whether the provincial system is equivalent to that federal backstop. And those criteria historically have included the price level and the coverage. So the number, sort of the percentage of emissions in the jurisdiction that are covered by the industrial policy, and then the price level. And so that's why right now, with the price dislocation that's happened in Alberta, there's a question as to whether the Alberta system would still be considered equivalent with the federal on the basis of pricing level. And so those discussions happen sort of annually. There's a review of the program, and then the federal government makes a determination whether the provincial program is equivalent or not. So we could see again the federal election has now kind of said, well, we're moving forward with that same industrial emitter policy. There will be an evaluation of Alberta's system in the coming sort of months and years, and that will influence the program. And then the second piece, I would say that's really relevant for this audience is again where we were talking about methane regulation. So some uncertainty prior to the election whether methane regulation, further methane regulations would be finalized. Again, still uncertain, but the platform was explicit about that. And so we see sort of the chapter 2 of that methane story really shaping up in a lot more concrete terms, as I was kind of outlining earlier.
Okay.
So short version, I would say methane abatement urgency and price support in the industrial emitter markets. Oh, sorry. One other actually, I guess, is there was some discussion in the platform around linking and harmonizing provincial programs. So I think that's a really interesting area that, we've been certainly advocating for as long as I've been working in carbon.
Okay, good. Thank you. The other question is, it is coming from our audiences, is how is fixed continuous emission monitoring for methane able to be used for carbon credits? So the question is using methane monitoring for the oil and gas industry, for example. How does that help to generate carbon credit? Is it like a measurement baseline versus year over year that account for the reduced emission somehow?
Yeah, so this is a good example where, like I was saying, kind of the 3 Ps. So monitoring emissions. So the question that I would ask is like, what is the project? In this case, if it's just quantifying emissions, then there's no actual intervention necessarily reducing emissions. It's the practice change or technology that reduces the emissions that would be the credit generating activity or project. Monitoring of emissions and quantifying of emissions is extremely important, but is not in itself a method currently to generate credits.
So I have some questions that been given to us from people when they were registering. You may have already answered some of them, but I go through the list. There's a question says, how does the tier program align with the efforts of the carbon trading market in the US? And are there synergies or challenges in harmonizing the two systems?
Yeah, great question. So since there is no federal carbon market in the US, and since the majority of provinces in Canada have elected to have their own industrial emitter markets, this question is actually more about aligning subnational systems. That presents, maybe some extra challenges in terms of layers of administration. But Quebec and California, Court mentioned, they are currently linked. Ontario was at one point intending to join that program, the Western Climate Initiative. But the only other talk that I've heard of Canada joining the US or vice versa has not been on the subject of carbon markets lately. And I think that's the principal challenge right now, right, would be, of course, the federal administration in the US. Not only themselves would not be interested, but they've also actually issued executive orders that take aim at state level carbon markets and systems. So I would not be holding my breath to see a carbon trading market between the US and Canada linking any further.
Okay, how about between Alberta and BC?
Yeah, this is, like I said, absolutely something we've been advocating for. I think it makes a ton of sense when we're sitting today in I will use the term oversupplied or underdemanded market in Alberta and a dramatically undersupplied market in BC. It's a new market within BC. They've, I think, still been pretty focused on just standing up the basic rules of the road within the BC OBPS. But we're hopeful that there could be linking for 2 reasons. One is I think of this as like the carbon footnote on the larger headline. The headline being reducing interprovincial trade barriers, and again that carbon footnote being including in carbon markets, please. And the second reason is that in the initial consultation for the BC OBPS, they did explicitly mention that they would explore linking with other provincial systems. So a lot of times I've been asked, like, just how would that work? And my preference, there's a million ways that it could work. My preference is to use existing mechanisms as much as possible rather than rewriting new rules. And so right now there is a system where a provincial program, so Alberta Tier has this, can be recognized by the federal program for linking. So basically trading a carbon credit from the Alberta market up to the federal OPIP-based pricing system. So that's called a recognized unit. That mechanism already exists, and there's nothing currently preventing BC from also recognizing recognized units. So I think this would
Mhm.
be a really great thing, especially for Alberta. In general, carbon markets need to be bigger, need that liquidity, that fungibility, but also there would be asymmetrical benefits to Alberta in terms of a new source of demand, but not necessarily a new source of supply. And so that's kind of, how does the BC, is there politics involved there? How does BC view that potential kind of value transfer across the border remains to be seen.
Okay, great. There's a question about your slide. On slide number 15, you stated your outlook on solar electricity generation, either grid or remote. Can you elaborate some more on this and how this compared to your view on fuel-powered electricity generation? So I feel the answer is, again, it depends on the project where you are using the solar powered electricity versus the fuel powered electricity.
Yeah, if the question is sort of outlook on electricity generation from fuel, I would say we're sort of, we're not the electricity department of BMO, so this is sort of personal opinion maybe. I think we're going to need a lot more power. Whether it's data centers and AI or other reasons, electrification I think is a mega trend that likely would see more of all types. I would say all types of generation.
Yeah. Yeah.
The only other thing I'd maybe add on that, Cooper, is that as far as maybe like the pricing component of it, a lot of solar generation was, I wouldn't say dependent on the sale of those offsets into the secondary market, but it was definitely a factor into like the economics of these solar generation projects where we see a deflated pricing in the secondary market on tier offsets that obviously would play like a major effect on these producers where if they were building economics into these at, a secondary market price at a 10 to 20% discount on what the actual fund price is, where now you're looking at like a 50 to 60, that's a pretty big dislocation on, like what maybe an expected revenue could be. So.
And what level of documentation is required to qualify for tier, and what are the key steps in ensuring compliance?
I can tell you what, that it is quite high, the level of documentation. Obviously, there's I wouldn't say that there's a set standard for it for whoever is generating the actual like credit generation. They would need like a high level of detail and a high level of documentation for the quantification of those credits. And then ultimately too, it comes down to the verification process. So, and then especially as things change as far as like methane abatement and credit generation go, we just see that level getting like tighter and tighter all the time. Another piece of it too is like if you kind of think of it as like a risk management approach, that if you're trying to mitigate the risk of these credits being invalidated or ineligible for generation, the higher the level of detail in the documentation and the data gathering obviously would mitigate that too. So there's not really like a black or white level of it, but it's better to err on the side of extra monitoring and documentation.
Okay. Good. There's a question about the tier program and LNG. How does tier help or hinder the development of Canada's LNG? Do you have any view on that?
Yeah, I think LNG's role as a global transition fuel is, I think Canada has really important aspirations there. I think that's a really important role that LNG can play. But if you look at it from, as many countries do, from sort of a life cycle basis, it's important not only that we develop the LNG and get it to those markets, but also that we develop it in a low methane intensity or low carbon intensity way. And so I think TIER, in my mind, by providing, even though we're not maybe on the coast, but like I said, in that life cycle of production, a lot of that gas could originate here in Alberta, and by providing an incentive, as we kind of talked about today, for methane abatement and for driving that methane intensity down with a payback and an incentive there, I feel that's kind of one of the most important roles that TIER can play in helping LNG to really, fulfill that ambition that we have.
That's great. Maybe the last question, what would be the impact of the federal fuel charge elimination on the TIER program and emission reduction project for Canadian oil and gas facilities?
Yeah, so I alluded to this a little bit. I think, it depends on the size of the facility. But again, if we go back to the history books, the reason that the TIER aggregate program was brought in was when the government eliminated the Alberta carbon levy, which had a carve out for upstream oil and gas. The provincial government got rid of the Alberta carbon levy. That made us that implemented the federal backstop, which did not have an exemption for upstream oil and gas, and therefore upstream oil and gas was subject to the federal fuel charge. In comes the TIER aggregate program to sort of, I'll say, shield the upstream sector. These are smaller facilities from the full hit of a federal fuel charge. And so then now if we fast forward to the federal fuel charge going away, I think there's a question as to why a TIER aggregate would remain in the program if they, have the option of not paying a federal fuel charge and not participating as a TIER aggregate. There's a lot of TIER aggregates that are generating EPCs. That would be a reason to stay in. But if you're in an obligation position, it's a question, I think, how you want to set your strategy. And then the second piece is, like I was saying, around overlap. So we have seen offset protocols like the engine fuel management one go away from the TIER program because they overlapped with the federal fuel charge, that and with the TIER aggregate program. That is, again, if we play out the change potentially to TIER aggregate as a result of the federal fuel charge, then that could open up offset generating opportunities for folks that are reducing that are managing their engine fuel use, as one example. But I think it opens up potential new pathways for offset generation.
Right. Thank you so much. We are 3 minutes past 12. It was a lot of information, very helpful. I would say if I want to have a main takeaway is that this is very complicated. It's not something that anyone can navigate on its own. They have to definitely get help. And especially considering that the time is limited for generating offset credit. And yeah. It was very helpful. Thank you so much. Thank everyone for joining us today. Please take a moment and help us to improve by filling out the survey. Thank you, Court and Cooper, for sharing your insight with our audiences. Thank you so much. Have a good day.
Thank you. Take care.
Thank you.
Yeah. Thanks, everyone. Bye.